So it appears that Shift has lost everything and they could be going under. The stock just hit a new low and the selling pressure has not stopped as the company has fallen over 90%. So in this video, I'm going to share my thoughts about the earnings report as well as talk about what I'm planning on doing with the stock that I've shared numerous times on this channel. But I don't want to waste your time, so let's go ahead and dive right in. Okay, so before we get into the actual earnings call, let's talk about the price action. Shift hit an all-time low of 60 cents back on June 16th, and for a month and a half, the stock went on an absolute tear, reaching a high of about $1.50. But after this most recent earnings, the stock has fallen massively and they are currently trading under 40 cents. Now, some people were looking at this and were wondering, why did the company fall so much? So I want to make sure that I cover some of those reasons. But let's go ahead and look at what they posted for numbers. So because the company is looking to merge with car lots, they had a massive change in their business. And this change led to them making estimates for the entire back half of the year and not quarterly estimates. And so Shift projected to have between $270 and $290 million in revenue for the second half of the year. But just in Q3, they reported about $162 million in revenue. Now, even though this looks like it could be in line to fulfill their estimates for the back half of the year, that is not what we're going to get. Along with their Q3 revenues, they provided revenue guidance for Q4, and let's just say that this may be lower than anyone ever expected. Shift is projected to be between $60 million and $70 million. So that means for the back half of the year, they are projected to have between $50 to $70 million less than expected. Now, if we look at this from surface level, this looks awful. I mean, who would want to be in a company that is experiencing revenue guidance drop almost 20%? Probably none. But here's one question that I believe every Shift shareholder needs to ask themselves. Why did Shift change their business model so that their revenues get slashed in a massive way? It's because they're trying to get closer to profitability. And this is where I want to talk about something that I believe is extremely important for understanding the new business model. Many people simply look at revenues as the leading indicator for how well a company is doing. But when you think about it, if the company grows revenues 5 times year after year and they are still a money-losing company, they could still run out of cash. So what's actually the most important thing for a company? Getting themselves to profitability. With all these changes, from cutting workers, moving to an online approach until the merger, and moving to more value vehicles to focus on GPU, they don't care much about growth right now. And especially in this economy, I think that this is smart for Shift. I mentioned this guy in a previous video, but Alex Hormozi talks about this relationship between margin and scale. As you scale or put more in, your margins begin to compress, and then you get in a place where you have to keep selling to maintain your overhead, but you're not really taking enough home and you can't have enough free cash flow to grow the business. This is exactly what we saw happen to Shift. So what is the answer? You need to rebuild your business, fix the product, fix the customer experience, fix the data, and fix the infrastructure. Shift is doing just that. They are reducing their channels to being online so they can reduce expenses. They cut jobs in order to have better margins. They are focusing on value cars to improve their gross profits, and this puts them in the position where they can focus on getting to profitability. And once they get to profitability, then they can begin to focus on growth. Because if you think about it, you can focus on growth after you are profitable. But if you don't have a profitable business, your revenue growth can only take you so far. So even though their revenue is probably going to be on the decline for all of 2023, they are really going to improve on their losses. And this is where I want to move to their adjusted EBITDA. For Q3, they lost a lot of money, and this got many people nervous, which is the major reason, in my opinion, that there was a massive sell-off. Their net loss was over $75 million in comparison to $52 million in the previous quarter. And even though this looks awful for the company, I think it's important to look at how the company is actually improving from an overall business perspective. And to do that, we have to look at adjusted EBITDA. So for Q3, they reported that their adjusted EBITDA loss came in at $30 million compared to $36.9 million in the second quarter of 2022. But what is nice to see is how much this will change for Q4. Their adjusted EBITDA loss is expected to be between $20 million and $25 million. To put things into perspective, last year their Q4 adjusted EBITDA loss was over $40 million. Now, one of the biggest concerns that investors had on the call was their SG&A, which is their selling, general, and administrative expenses. This number appeared to be kind of high, but what these investors, including myself, didn't recognize is that the month of July was still under the old strategy as they began to transition to the new. And this transition was costly too, from restructuring the hubs and liquidating the inventory to focus more on value vehicles. So this upcoming quarter is going to be telling for how much reduction they have in their SG&A. Now, Oded Shine, the CFO, did say that as they are providing guidance for the next year, you will see improvements in volume and better unit economics on the SG&A side. Now, this is an interesting thought because in some people's eyes, the company may not even be able to get to 2023. But even when investors during the conference call asked if Shift would be able to have $125 million in cash after the combined merger, not only did Shift's management team say that they will be able to achieve this, but the CEO said multiple times that they will have at least $125 million. So for a company that many people are believing is going to go under, they have a good amount of confidence to not only get through these difficult quarters, but enter the merger where they could have enough cash to get them to profitability. And if we're honest, every single company is down 90% from their highs. So the question is no longer who is going to be the number one player, but it's whether or not Shift will be able to survive. And I firmly believe this is dependent upon the merger of car lots. Car lots recognize that even if they could achieve profitability in the next year or two, they would not be able to keep up because their product is not strong enough. Their physical locations worked well, but their online product just wasn't good enough. And if we look at where the world is headed, it's going to be away from physical locations, moving to online. So this tells me that Car Lots wants this merger to go through. And given Shift's low cash position, there is no doubt that they want the same thing. Now, one thing that I was impressed with is that they are expecting their adjusted GPU to be higher than they expected for the entire year, going from between 1600 to 1700 to 1700 to 1800. And because they are focusing more on value vehicles, which are vehicles 8 years plus or over 80,000 miles, this will also help them with adjusted GPU. One thing that I've said numerous times that is a caution flag with Shift and other used car e-commerce companies is that they have razor thin margins. So improving gross profits are extremely important. When you think about the car industry, there's only so much you can do to add value to the vehicle and receive fees through the transaction. So you need to rely on services outside of the car itself. And that is where the other GPU comes in. This category includes the term F&I or financing and insurance. Shift reported adjusted other GPU of $1,243, which was over 26% higher than last year. Now, we are expecting this number to moderate given the shift to value vehicles, but because value vehicles have higher margins, this should offset the moderation. And that is important because when we consider the current market where interest rates are so high, financing is just not going to be a big part of Shift's business. So I think this move to value is smart. Now, they did announce during the conference call that over the past year, many dealers have been impressed with Shift's Sell Your Car flow, which allows Shift to source 95% of their inventory directly from customers. And with dealers becoming more interested in this model, Shift is launching the Auto Acquire platform, so the company can partner with dealers to use Shift's website flow into their own website, so customers can sell their cars to them. And speaking of partnerships, they have announced a significant partnership with Off Lease Only. And let me tell you that Off Lease Only is not a small company. They have 5 locations in Florida, and these locations are not small either. Across these locations, they have a total of over 23,000 reviews. This will launch in Q4, and then the platform will open up to additional dealer partnerships later on. Plus, with the relaunch of their Shift marketplace powered by Fair in the first half of 2023, this could give them brand awareness, but also be a huge help for Shift's margins for their marketplace business when that is complete. And for transparency, this will only be massive for the company if they get through this merger and have the cash needed to get through 2023. I think for many of us, the biggest caution flag is the amount of cash burned that Shift has experienced in the past. In Q1, they burned so much cash that it cut their cash and cash equivalents over half. So many were worried that they would just run out of cash, even to the point where they couldn't provide the funds needed for the merger. This quarter, the company reported having $44 million in cash and cash equivalents, as well as another $12 million in restricted cash. Now, this was lower than the second quarter, but much of this reason was from what I said earlier with the cost of restructuring. They also significantly reduced their debt outstanding under the floor plan facility from $94 million to $42 million, which is also nice to see. But the other thing to consider is that they have also reduced their inventory, which in this kind of environment where there are less people buying cars and they are trying to keep expenses low, this is a smart move in my opinion. Now, I want to touch on something that has gotten everyone freaked out, and that is the possibility of a reverse stock split. On October 7th, it was reported that Shift is not compliant with the current NASDAQ standards. This means that the company has a period of 180 calendar days from the date of notice, or April 3rd, 2023, to get back to fulfilling the NASDAQ standards. The thing that I believe many people missed was the possibility for a reverse stock split was announced back in August when the merger was announced, but it wasn't mentioned until September 26th when it was announced what was going to happen at the special meeting, and this frightened many people. But I want to ask the question, what actually makes the reverse stock split bad news? What I believe is that reverse stock splits are associated with bad companies who ended up either going bankrupt or failed to get back to where they were. And so anytime the word is mentioned for a company, it leaves a bad taste in people's mouths. But Shift is probably going to do the reverse stock split to get back to being compliant. Does the reverse stock split affect their overall business? No. And so we need to understand the actual reason for this kind of news. Let me put it this way. Shift is outperforming Carvana and Vroom, which are their top competitors in the space. I think much of the fear is in the fact that Shift is under $1, and because the reverse stock split has a negative connotation, it appears that the business is failing. However, even though many people believe that reverse stock splits are horrible news for a company, this isn't always the case. In my previous video, I shared the fact that in 2011, CNBC did a report that showed there were numerous companies who succeeded coming off a reverse stock split. Companies like Raytheon, CBS, Discovery Communications, and Time Warner all performed exceptionally well following the reverse stock split. And this is why it is so important to understand why the company would take this route. Now, there are a couple of things that I want to mention about this news that I believe needs clarity. First is that the reverse stock split will occur after the merger goes through. This is important because it won't have much of an effect on the Shift to car lots exchange ratio. Secondly, Shift can have a ratio of 5-to-1 or 10-to-1. I firmly believe that assuming the merger goes through, they will probably go for the 10-to-1 so that they are well protected from falling back under $1 again. But we will see what the company will do after the merger. That being said, this merger has not officially gone through yet, so please consider that when buying the stock. If we see a delay in the merger, we need to ask ourselves whether or not we believe these companies can last when we look at their cash burn. We have seen companies over the past few years enter a merger with another company and it fell through. And even though there are plenty of signs that point to the merger going through, I remain cautious with my position in this company. I recognize that this continues to be a risky play, and that is a major reason why it is one of my smallest positions in my portfolio. So I've only been adding a few shares, but like Opendoor, they're my smallest adds because I'm building a massive position in Shopify, which if you haven't seen their Q3 earnings report, I made a video talking about them here. And this company has already gone up over 30% since I started buying. Hope you all enjoy the rest of your week, and I'll see you in the next one.